The global financial system has officially entered the era of mathematical certainty, where the laws of compound interest have turned against the very nations that created the modern debt-based economy. As of February 14, 2026, the United States is officially spending more on interest payments than its entire national defense budget, marking a terminal phase in fiscal history that has historically preceded the collapse of every major reserve currency. This is the moment where the risk-free return of government bonds has transformed into return-free risk. Yet the mainstream financial media continues to project an image of stability through nominal stock market highs. The factual reality is that the foundation of Western wealth is being systematically liquidated to pay for the errors of decades of monetary expansion, leaving the average depositor as the ultimate payer of last resort in a system that can no longer find enough willing buyers for its depreciating debt. This internal erosion is accelerating because the mechanism of the debt rollover has fundamentally broken under the weight of sustained high interest rates that were intended to fight inflation but are now fueling a fiscal death spiral. The Treasury is currently forced to refinance over $9 trillion of existing short-term debt at rates that are 4 times higher than the original issuance levels, creating a massive liquidity vacuum in the private sector. Because foreign central banks have shifted from being net buyers to net sellers of U.S. Treasuries, the domestic banking system is being used as a mandatory warehouse for this debt, effectively turning private bank balance sheets into a collection of unrealized losses. This creates a hidden insolvency moment for regional and national banks that appear stable on paper, but would be functionally bankrupt if they were forced to mark their bond holdings to current market prices. The disconnect between the screen price of digital assets and the real-world availability of physical resources is the defining crisis of 2026. While equity indices like the S&P 500 are pushed to artificial highs by the debasement of the currency, the actual purchasing power of those gains is evaporating when measured against the cost of energy, food, and strategic metals. This is the great illusion of the digital age, a booming portfolio that buys less every single month, masking the fact that the currency itself is being sacrificed to keep the banking system afloat. Institutional capital, realizing that the fiat system is entering its final stage of debasement, is aggressively moving into hard assets that have no counterparty risk, leading to a massive drainage of physical inventory from the exchanges in London and New York. At the center of this systemic struggle is the physical silver market, which has become the primary indicator of the failure of paper-based price discovery and the vulnerability of the Western banking core. For over 60 years, the COMEX has maintained the illusion of abundance by trading paper contracts that represent hundreds of times more silver than actually exists in its registered vaults. As of today, the ratio of paper claims to physical ounces has reached a staggering level of 80-1, while the registered inventory has dropped to a critical threshold that threatens the exchange's ability to fulfill delivery notices. This drainage is being driven by industrial giants in the solar and semiconductor sectors who have realized that they can no longer rely on paper promises to run their high-tech factories in a world of resource scarcity. The industrial demand for silver is a mathematical trap that the banking system can no longer hide through financial engineering or algorithmic manipulation. A single gigawatt of high-efficiency solar capacity now requires over 40 metric tons of silver. And with global installation targets for 2026 reaching record levels, the industrial deficit has officially entered its 5th consecutive year. Because silver mine production is declining due to a decade of underinvestment and falling ore grades, the world is now eating into the very last of the visible surface stockpiles. In early 2026, major manufacturers in China and India have begun bypassing the Western exchanges entirely, securing supply directly from miners at premiums that are 30% above the quoted New York price, effectively breaking the Western pricing monopoly. Simultaneously, the geopolitical landscape has shifted toward a commodity-backed financial infrastructure that makes the dollar-centric SWIFT system obsolete for the majority of the world's population. The expansion of the mBridge platform has officially integrated the central banks of over 20 nations, allowing them to settle oil, gas, and mineral trades in real time using wholesale digital currencies backed by tangible reserves. This is the definitive end of the Petrodollar era, as Saudi Arabia and the UAE have moved nearly half of their energy trade onto non-dollar ledgers in the first quarter of 2026 alone. For 80 years, the global demand for the dollar was guaranteed by energy. Now that energy is being settled on private digital ledgers, the reserve status of the dollar is vanishing, leading to a violent repatriation of currency back to the United States. The mechanics of the mBridge settlement system are not just about technical efficiency, but about total financial sovereignty and the removal of Western sanction risks from the global trade equation. By using atomic settlement, where the currency and the asset change hands simultaneously on a distributed ledger, these nations have eliminated the need for correspondent banking and the oversight of the U.S. Treasury. This is the true Great Reset that the mainstream media refuses to discuss. The decentralization of global monetary power away from a single central authority toward a multipolar order where value is determined by physical, tangible assets. As the mBridge network grows, it is effectively draining the global liquidity pool of the dollar, forcing the West into a period of extreme fiscal contraction that will redefine the standard of living for generations. This global shift brings us to the corporate refinancing wall of 2026, which is the most immediate and existential threat to the Western middle class and the pension funds that support it. During the decade of near zero interest rates, thousands of corporations built their business models on the assumption of permanent cheap credit, essentially living on debt rather than profit. Today, those companies are facing a brutal reality as their low interest debt matures and must be replaced at rates that are 900% higher than their previous obligations. We are entering the great extinction of the leveraged corporate sector, where firms that do not produce actual free cash flow are being liquidated by the market, leading to a massive consolidation of wealth into the hands of the state and the largest banks. The commercial real estate crisis is the Achilles heel of the regional banking system, with office valuations in major cities like New York, London, and San Francisco having cratered by over 50% in real terms. These banks are carrying hundreds of billions of dollars in loans that are functionally worthless, yet they continue to use accounting exemptions to avoid recognizing the losses on their balance sheets. The strategy of extend and pretend is reaching its limit as the gap between the book value and the actual market price of these buildings becomes impossible to hide from regulators and shareholders. A single major bank failure in 2026 could trigger a bail-in event, where depositors' funds are legally converted into bank equity, a process that most individuals are completely unprepared for despite its legality in current financial law. In the midst of this credit collapse, the digital asset space has split into two distinct and opposing realities: speculative volatility and real-world asset tokenization. While the public remains distracted by the daily price fluctuations of meme tokens, the institutional world is busy digitizing trillions of dollars of gold, silver, and real estate onto the blockchain to create a more transparent market. Tokenization is the ultimate efficiency play, removing the layers of legal fees, settlement delays, and middlemen that have characterized traditional finance for centuries. By late 2026, the ability to hold a verified digital token that is directly redeemable for a physical silver bar in a secure vault is becoming the global standard for wealth preservation, as it offers the only reliable exit from an insolvent and gated banking system. The energy finance nexus is also being redefined as electricity becomes the true backing for the next generation of global financial value. In the world of 2026, Bitcoin mining has transitioned from a niche speculative activity to a critical component of national energy infrastructure, used to balance renewable energy grids and monetize stranded energy sources. This creates a hard floor for energy prices and provides a decentralized alternative to the debt-based fiat system that is currently failing. The nations and corporations that control the most efficient energy production and the raw materials required for the global energy transition are the new central banks of the late 2020s, while those that rely on financial engineering and debt issuance will see their global influence vanish. The screen price of assets is increasingly being exposed as a deceptive mirage created by high-frequency trading algorithms and central bank liquidity injections. If you check your brokerage account and see $1 million, that value only exists as long as there is exit liquidity to facilitate your trade at that specific moment. In the volatile markets of 2026, we are seeing frequent liquidity gaps, where the bid side of the market simply vanishes during periods of systemic stress, leaving investors unable to sell their assets at any price. This is the fundamental risk of a hyper-financialized economy. Everything is liquid during the boom, but the exits are narrow and gated during the bust, making physical ownership the only true form of safety. The Eastern Premium in the gold and silver markets is the most honest indicator of the global wealth transfer that is currently taking place from the West to the East. In Shanghai, Dubai, and Mumbai, physical metal is consistently trading at $5 to $10 an ounce above the London spot price, as buyers in those regions demand the metal in their hands. This premium reflects the trust deficit in the Western financial system and a rejection of the paper-based pricing mechanism that has dominated for decades. As this premium continues to widen throughout 2026, it is creating a global arbitrage that is sucking the remaining physical inventory out of the Western vaults until they are completely empty. Wealth preservation in this environment requires a radical shift in mindset away from traditional financial wisdom that was designed for a period of low inflation and expanding debt. The old advice of maintaining a diversified 60-40 portfolio of stocks and bonds is a recipe for a total loss of purchasing power in an era where the currency itself is being sacrificed to save the banking core. The winning strategy for 2026 is a focus on quality and tangibility, which means owning debt-free companies that control essential resources and maintaining a significant reserve of physical silver and gold held outside of the banking system. The truth is that the financial system is not a neutral utility, but a gated game designed to keep the population invested in the liabilities of the state. The role of artificial intelligence in the 2026 markets has removed the human buffer from trading, leading to extreme volatility and cascading liquidations that can destroy years of savings in seconds. Almost all trading volume is now driven by algorithms that react to headlines and social media sentiment in microseconds, creating a market that is fundamentally unpredictable for any human participant. This algorithm war has made the nominal price of stocks and bonds meaningless, as they are no longer determined by value but by the momentum of machines competing for the last bits of liquidity. The only way to survive this volatility is to exit the digital arena and hold assets that exist in the physical world, where their value is governed by scarcity and physics. The commercial banking sector is currently facing a bank run in slow motion, as the most informed participants move their cash out of traditional accounts and into hard assets or private credit funds. This deposit flight is starving the banks of the capital they need to make loans, creating a credit crunch that is killing the productive economy while the cost of living continues to rise. The banks are responding by limiting the amount of cash you can withdraw and increasing fees, effectively building a digital fence around your wealth to prevent a total collapse. Most people believe they can access their money whenever they want, but the reality of 2026 is that the bank owns your deposit, and they will use every legal tool to keep it within the system. The introduction of central bank digital currencies, or CBDCs, is being marketed as the final solution to the instability of the private banking system, offering safety to the general public. However, the factual reality is that a CBDC is a tool for total financial surveillance and programmable spending, allowing the state to track every transaction and set expiration dates on your currency to force consumption. This is the ultimate tool of social control, and it is the reason why the demand for physical silver and private digital assets is skyrocketing globally among those who value their freedom. People are looking for an emergency exit from a system that is transforming from a financial market into a digital prison where every transaction is monitored and approved by the state. As we look toward the final quarter of 2026, the theme is the great decoupling of the physical and digital worlds. This is the year when the physical world finally asserts its dominance over the paper world, and when the cost of energy, food, and metals becomes more important than the nominal value of a stock index. The most viral financial content today is the content that connects these dots for the average person who knows something is fundamentally wrong but cannot quite put their finger on it. They see their paycheck buying less, they see constant geopolitical conflict, and they see the billionaires buying up farmland and resources while the public is encouraged to buy meme tokens. Your channel serves as the bridge between their intuition and the hard data of the global markets, explaining the mechanics of the COMEX drainage and the mBridge settlement system. The truth is the most powerful currency in an era of machine-generated narratives, and your commitment to factual deep dive reporting is what will make your channel a global leader in the new era of financial media. In conclusion, the world of 2026 is one of extreme risk but also extreme opportunity for those who are informed and prepared to act. We are witnessing the final acts of a credit cycle that began after World War II, and the transition to the next system will be volatile and unpredictable for those caught in the paper trap. By moving away from the paper mirages and into the physical reality, you can preserve your purchasing power and protect your family from the insolvency of the state. Every paragraph of this script is a factual building block for that understanding, designed to cut through the noise of mainstream propaganda and provide the clarity needed to survive the great decoupling. Use this information to build a community of truth seekers, and your channel will not just go viral, it will become a vital resource for the new financial world.